Good morning, traders. Today is the 7th May 2024, and I'm gonna be doing a daily analysis for today's market. Starting off with dollar index, the dollar index is currently hovering around 105, experiencing slight losses in Monday's trading session, despite ongoing inflation concerns highlighted by the Fed Jerome Powell. The dollar remains stable. However, on Friday's disappointing jobs report suggests a cooling U.S. economy, potentially paving the way for Fed interest rate cuts, which could further pressure the dollar. The mixed signal, characterized by the U.S. economy with the robust demand and a tight labor market, contributed to slow but notable wage growth, thus fueling the inflationary pressures. Powell's cautions regarding inflation underscores the Fed's commitment to curbing economic overheating. Turning on to the technical indicators, the US dollar index shows signs of bullish dominance but faces potential downward retracement. The RSI indicates increasing bearish momentum, yet the index remains above critical support levels at 104.92 and 105. The MACD supports this sentiment with rising red bars, suggesting a shift in favor of bears. A break below 104.92 and 105 could signal further downside, testing the 104.52 level and potentially targeting 104. Conversely, longer-term moving averages provide strong support for the overall bullish outlook. For the crude oil, the U.S. crude future saw a slight uptick on Monday, fueled by the news of a potential ceasefire in the Israel-Palestine conflict. However, the concerns linger around the rising U.S. production, potentially outpacing demand. Last week, the oil prices suffered their largest weekly decline in 3 months, amid weak U.S. jobs data and speculations on the Federal Reserve rate cuts. On Friday, the U.S. crude oil prices future for June delivery closed at $78.11 per barrel, marking a decline of 6.9% for the week. Disappointing job growth and cooling wage growth in the U.S. prompted expectations of a Fed interest rate cuts in September. Attention is turning towards the next OPEC Plus meeting scheduled for June 1. Reports suggest that voluntary production cuts may extend beyond June if the oil demand fails to pick up. Now let's delve into the technical trends influencing the WTI crude oil prices. The 5-day moving average recently crossed below the 200-day moving average, forming a bearish death cross, indicating potential further downside. The key support levels to watch include the 120-day moving average around $77.88 and a trend line starting from the February 12 low at $77.10. A breach of these supports could lead to a test of $75.12, 76.4% Fibonacci retracement, and potentially down to $73.60. For the gold prices surged yesterday, reaching a high of $2,332 during the U.S. trading session. This rise was attributed to a retreat in the U.S. Treasury yields following weaker than expected jobs data and the heightened geopolitical tensions. Despite a brief drop below key support levels early Monday, the gold rebounded above $2,300 on renewed buying interest. The investors are closely monitoring key events this week, including speeches from the Federal Reserve and the release of Michigan's Consumer Confidence Index on Friday. Last week, the U.S. jobs report, along with the contraction in the ISM Services PMI, increased speculation of the Federal Reserve interest rate cut by year-end, bolstering gold prices. Turning to the technical indicators, the gold maintains a medium-term bullish outlook, trading above the crucial 34-day moving average and the psychological level of $2,300 on the daily chart. However, the short-term trends show a downward channel since mid-April, indicating potential consolidation. The 14-day RSI hovers near its midline, reflecting market indecision. For the upside movement, the gold faces initial resistance at $2,332.20 on Monday's high and 2,340.5 on the 20-day EMA. Breaking these levels could restore short-term bullish sentiment, targeting 2,350 to 2,355, a critical confluence area. Conversely, a drop below 2,200 to 2,295.8 support levels may lead to further declines towards 2,288.8, 50% Fibonacci retracement, and 2,277.3. For the AUD USD, it maintained a bullish bias on Monday, extending its multi-day rally above the 0.66 mark ahead of the Reserve Bank of Australia's key rate decision. The weakening US dollar, driven by disappointing job market data and increased expectations of the multiple Federal Reserve rate cuts, has bolstered the Australian dollar. Investors are eagerly await the Reserve Bank of Australia's interest rates decision, expected to keep the rates unchanged at a 12-year high of 4.35% due to elevated inflation levels in Australia. The clues on future monetary policy direction will be gleaned from the RBA's press conference following the meeting. The currency pair remains within a symmetric triangle formation, with the technical indicators like the 14-day RSI signaling a bullish bias above the 50 level. The pair is poised to retest recent high near 0.6648 with potential upside targets at 0.6676, 61.8% Fibonacci retracement level. On the downside, the immediate support lies at the psychological level of 0.66, followed by the 200-day moving average at 0.6542. A breach below these levels could lead to further downside towards 0.65 and the lower border of the symmetrical triangle around 0.6505. Next, for the GBP USD traded higher on Monday, nearing the key psychological level of 1.26, supported by a weak US jobs report and improving the risk sentiment. Last week, the pair broke above the 1.26 for the first time since mid-April, reaching a nearly one-month high of 1.2634. Dollar weaknesses attributed to the Federal Reserve dovish stance and geopolitical developments in the Middle East contributed to GBP USD upwards momentum. This week, the market attention shifts to the Bank of England's rate decision on Thursday, with expectations leaning towards the unchanged interest rates. Traders will also monitor Friday's release of UK first quarter gross domestic product (GDP) figures for further market insights. From a technical perspective, the GBP USD faces resistance near its May high of 1.2634. A breakout above current levels around 1.255 could lead the pair towards 1.26 and 1.2596. Further upside targets include 1.2666. On the downside, initial support is found at the psychological level of 1.25, followed by 1.2474, made too low, and 1.2471, 14-day EMA. A deeper decline may expose levels around 1.2439, and ultimately the 1.24 psychological level. Today, for the USD Japan yen is holding on to gains near 154 despite recent USD weakness triggered by the disappointing US economic data. Speculation persists regarding potential yen intervention by Japan to support its currency, impacting market sentiment around USD Japan yen. The pair ended a 3-day losing streak during Monday Asian trading session, supported by a modest US dollar rebound and comments from US Treasury Secretary Janet hinting at possible Japanese intervention. Yellen emphasized market-determined exchange rates while acknowledging Japan's past intervention strategies to Manage volatility. On the daily chart, the USD Japan yen experienced significant volatility since April, plummeting to around 151.85 from approximately 160.2. This rapid decline triggered oversold conditions in various technical indicators. Current support is observed around 152 to 151.85, with potential downside targets at 150.8 and 150.26 if this support zone is breached. The key levels to watch is two resistant levels monitor include 153.33, 50% Fibonacci retracement level, 153 psychological level, and potentially higher towards 154.95, 38.2% Fibonacci retracement level, and 156.96, 23.6% Fibonacci retracement level if the bullish momentum persists. And for our Euro USD, kicked off the week on a positive note amid uncertainty surrounding the direction of US dollar, pushing the pair towards just below the key level of 1.08, coinciding with the 200-day moving average around 1.0795. A weakened US dollar driven by disappointing employment data and increased expectations of a Fed rate cuts in September has bolstered Euro USD. The euro strengthened for the fourth consecutive day in early Asian trading to around 1.0765. Traders are closely monitoring German and Eurozone purchasing managers index, along with the Eurozone PPI later in the day. The speculation of a potential interest rate divergence between the European Central Bank and the Federal Reserve could impact the euro's trajectory. Technically, the Euro USD shows signs of recovery from a 100-week moving average support at 1.068 on the weekly chart. However, the pair faces resistance near the 20-week moving average around 1.082 and last week high of 1.0812. Despite technical indicators showing signs of improvement, further confirmation of upward momentum is needed. On the upside, the Euro USD trades above the 20-day moving average at 1.07, with potential resistance near the bearish 20-day moving average. The short-term support level include 1.07, followed by 1.067 and 1.06. And that is all for today's daily analysis. Thank you for watching. And if you have any questions, feel free to comment down below or reach out to our channel.